There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice, brought to you by TackleTrading.com.
Welcome back to the Trading Justice podcast. This is Matt Justice, your host of the podcast. I am going to do a little singular one-on-one podcast here, talking about what drives the financial markets, and we'll talk a little bit about fear and greed and fundamental analysis, a little bit about technical analysis. So sit back, enjoy the next hour as we talk about what drives the financial markets. And when we're talking about the financial markets, we are talking about the currency market. We're talking about the commodities market. We're talking about the equity stock market. We're talking about the options market. Every market is what we're talking about. Now, the Trading Justice podcast, a 5-star rated Trading Justice podcast, is brought to you by TackleTrading.com, where we are changing people's lives one trade at a time over there at Tackle Trading. So get in the game. Go over to TackleTrading.com, sign up for that pro membership. It's $97 a month, ladies and gentlemen, and it absolutely pays for itself with my amazing Forex report and Gino Poor's options report and the Tackle 25 and Noah Davidson's Tackle ETF list. Get out there, change your life one trade at a time. Presented by Tackle Trading. All right, let's talk about what drives the financial markets. There are three basic things that drive the financial markets. The first one is what we call behavioral. That's the emotions of the market, meaning fear and greed. The second one is what we call fundamental or economic. Those are economic reports, earnings reports, stock fundamentals, market fundamentals, individual fundamentals, you name it. You have fundamental analysis for people, debt to income ratios, credit scores. You have fundamental analysis for companies, P ratios, PEG ratios, debt to equity, revenue, sales, guidance reports, earnings reports, you name it. You have market fundamentals. You have government fundamentals. You have central bank fundamentals. There's a lot that goes into fundamental or economic analysis. And then you have technical analysis, which is trends and patterns and support, resistance, and buying at support, selling at resistance. Now, what technicians, and I would consider myself a technician much more than a fundamentalist, but from a technical perspective, technicians believe in what's called the efficient market theory. What the efficient market theory states is that everything known in the market is embedded in price action. So economic reports are embedded in price action. Earnings reports are embedded in price action. Market fundamentals are embedded in price action. Now, the one that we trade on is not the behavioral. Okay, that just kind of helps us understand the fear or the greed in the market. We don't trade on the fundamental or the economic. We trade on the technical cycle. That's where we make determinations to buy and sell, and that's where we make determinations where to manage individual trades as well. Now, you have two primal human emotions. The first one is fear. Now, everybody has fear. I don't even care how long you've been trading. Every single person has fear of losing capital, fear of missing opportunity. Everyone also has greed, mismanaging profits, missing an opportunity. Fear and greed are very similar emotions in how they manifest themselves in the market. Fear, losing capital, missing out on trades. Greed, losing capital, missing out on trades. Okay, we have to understand what drives the marketplace so that we can prepare for the emotion of the market, number one. But even as that, okay, once again, even as a trader for 10 years or 20 years or 25 years or whatever the case might be, we're going to have emotions in us. I can promise you that. We're emotional beings. We limit the emotion in the trades, though. You as an individual might have emotions. That doesn't mean the trade does. In every trade we make, whether it's a covered call, a naked put, long call, long put, short stock, long call, short euro, long dollar, short crude, regardless of what the actual trade is, we need to know three things. The first thing we have to know is the concept of order entries. understanding where our entry is, understanding where our stop loss is, understanding where our target is. So those are the three things that we need to know going into every transaction, and we know those things. We place orders out there in the marketplace so that when those things happen, we are already taking advantage of it. And through order entry and through preparation of order entry, through your entry, target, stop loss techniques, you can control the emotion in the trade. Now again, you as an individual, you might have some emotions out there as an individual, but the trade has none. Now when you talk about the emotional pitfalls of consumers out there in the market, the consumers do not have a game plan. And even when they come into the market because they read a book or they went to a website or they went to Investopedia, they still don't know how to trade. They're aware that something exists and they go out there and they go try their best at it, and then they get it handed to them, and then they say things like everybody loses money in trading, which is theoretically impossible since money simply exchanges hands when it comes to trading. Now, understanding the emotional pitfalls can help us understand that we need to have a plan of action. As the market goes up, as the market goes down, as the market goes sideways, we have to have a plan of action of how we are going to combat every marketplace. Now, in terms of the behaviorals, once again, we control the emotions of the market through orders and technical analysis, and we keep all emotion out of the business of trading, because at the end of the day, trading is a zero emotion business. It is a zero-sum ball game. We control emotions through order entry and application. Now, fundamental analysis can once again be performed on many things: personal, corporate, economic, sovereign, when to buy, what to buy, why to sell, what to sell, those types of scenarios. Now, as an individual, we certainly have to take control of our personal fundamental situation. In going around, like I was in a training the last 3 days there in Chicago, and Brian was there with me, and in that training, and Brian will attest to this, almost everybody wanted to move forward with Master Trader, correct, Brian? I mean, almost everybody was like, yes, I want to do this, I want to do this, I want to do this, but not everybody could, because not everybody was in the financial situation that they could. And what I said to the crowd at the end of the presentation, I said, you know what, guys, I get it. I get it that you want this, you need this, you desire this, but for one reason or another, you are just not in a financial situation where you can do this. So start putting yourself in a situation where in the future where you can. And I talked about, making sure that you're saving money instead of just spending. Cut out the expenses on a monthly basis that you truly don't need. Start working on improving your credit score, and that goes back to everything from a personal fundamental situation. What is our expenses? What is our income? Make sure our income far exceeds the expense column. Make sure we're starting to build assets, and make sure we're starting to limit the liabilities out there. Because at the end, regardless of how we make money, if you're positive cash flow, you can start to make some positive changes in your life. The problem for most people in American society today is their negative cash flow on a monthly basis. They bring in money, they spend money, and then they just blame things like, oh, it's life is very expensive right now. Well, you're right. It's expensive for all of us. Some of us have put ourselves in a better situation financially than other people who have not prioritized. And I love that word, Kevin. They have not prioritized. And so when we're looking at a personal fundamental analysis, let's make sure that us here, we keep an eye on that as well, making sure that our expenses are limited to the things that we need, and making sure when we do buy things that we otherwise do not need, why don't we cash flow on those instruments first? That's just my mindset. Why don't we go out there, and if we want to buy that, like I was saying to the group in Chicago, if you want to buy an iPhone, fantastic, go trade Apple. Make money on Apple so that you can buy the iPhone. There's nothing wrong with that. We don't have to continue to work to make money. Let's get it working in the marketplace itself. Looking at corporate fundamental analysis, price to earnings ratios. It's called a PE ratio. It's one of the most traditional forms of what's called valuation of a stock. Is something overvalued, undervalued? Is it fair valued? Well, we look at price to earnings ratios and PEG ratios in terms of understanding if something is overvalued or fair valued. Now, the PE ratio is basically the price to the earnings. Now, most companies will trade not for the current earnings, but for the future earnings, 20 times over the earnings. So they're looking at future projections, and that's what the PE ratio does. It takes price in comparison to earnings. Now, it's not, and I made sure I wanted to make this clear, P ratios traditionally are tracked at a 20 valuation. Okay, 20 times earnings. If something is over 20, that is overvalued. If something is under 20, that is undervalued. Now, I said it's not as simple to say the P ratio over 20 is overvalued and under 20 is undervalued. Because let's say hypothetically, I'm looking at a stock in a bullish uptrend and it has a 45 PE ratio. Traditionally, that would be what? Very overvalued. Well, in that case, what if the sector's P ratio is 65? That means that the stock in comparison to the other stocks in that same sector is undervalued. And coming back to the tackle 25, I don't know if you guys caught this, but remember, when I list the P ratio on the company, I don't just list the stock, okay? I also list the industry group. I also list the sector. So, for example, here, Alaska Air Group is a company I really like. It's an up-and-comer. I also like Southwest as well. But in terms of the industry, it's in the regional airlines industry. The sector is in the services sector. The price to earnings ratio, the P ratio for the stock is 14.85. Well, that traditionally is undervalued. But now look at the industry. The industry P ratio is 38. The sector's P ratio is 32. That tells me that this company is ridiculously undervalued. And look at the trend on Alaska Airline. This is a really nice bullish uptrend, and so we have a nice bullish uptrend. The stock's really undervalued. The industry's a little overvalued, which means I kind of like this stock even more. So I just want to show you kind of the comparison very quickly of the P ratio. Brad's good with me too. Okay, so let's take a look at a couple P ratios here. Number one, what is the trend of CMG? What is the trend of CMG? This is a bullish uptrend. Okay, should I invest in CMG based on the trend? Based on the trend, yes, absolutely. But just because I can invest in CMG doesn't mean I should, right? Just because I can jump off a cliff doesn't mean I should be a lemming like everybody else and jump off the cliff. Taking a little further. Now, again, trading short-term CMG, we could care less about P ratios, PEG ratios, debt-to-equity ratios, you name it. We could care less about that. It's all technical analysis. But I said, should I invest? Should I look long-term? Should I look at investing in CMG over the next year, 2, 3, 4, 5 years? Well, CMG's current price is $710. It's in a bullish uptrend. Its P ratio is 55.37. Its sector is 31.65. Its industry is 25.6. Now, given the fact that we now have a little bit more information, should we still invest in CMG? The equation is no. A long-term investment in CMG is not advised because not only is it above that market valuation of 20, it's doubled the industry at 55 compared to 25. It's 24 points above the P ratio of the average sector. So the answer would be no, I should not invest. Now, here's Boeing. Should I invest in Boeing from a technical perspective? What do you guys think? Or can I? Yeah, it's a good company. We all know Boeing. It just broke out of resistance. By the way, that was an earnings report that kind of drove it up. Okay, now Boeing, $145 company, its P ratio is 17, its industries is 18, and the sector itself is 26. So the conclusion, yes, an investment in Boeing could be advisable due to the fact that it's an undervalued company. And so when we're looking at these longer term investments, again, there's a difference between short-term analysis and longer-term analysis. Short-term analysis, it's all technically driven. We could care less about long-term fundamentals. But if I'm looking at a place to put some money for the next year, 2, 3, 4 years, and I want to capture a dividend, I want to do some covered calls, I want to make sure that I'm investing in a company that is not only technically strong, I want to make sure that I am investing in a company that is fundamentally sound as well. And then you have what's called the market P ratio, which is the Shiller P ratio. The market P ratio helps us understand how companies in the entire S&P 500. The entire S&P 500. The Shiller P ratio is the average company for the S&P 500. The Shiller P ratio right now is 26.2. So is the market overvalued, fair valued, or properly valued? Yeah, it's overvalued. It's absolutely overvalued. The average P ratio in terms of the Shiller is about 16.58. It's at 26.2. Now, I know it's kind of hard to see here, but you see that little blip right there? That was 2008, ladies and gentlemen. 1987, that was Black Friday right there. Me and Brian were talking about Black Friday right there. That was, I think it was somewhere around 17 on the Shiller P ratio. Black Tuesday in 1929 was right at 30. Okay, and so in looking at this, the only one that got completely out of whack was the .com, and everything was completely out of whack in the .com. So in looking at the Shiller P ratio here in comparison to the history, and this is tracking it all the way back since 1870, ladies and gentlemen, where is the market going to go in the future? Can it continue to go up? It's just going to have such a hard time to continue to go up, guys. It's going to have such a hard time. Number one, where's the money going to come from? That's number one. Number two, it's already so far overvalued. When a market gets so far overvalued, it basically has to put more and more and more and more money into it. Well, guys, I read a stat just the other day that from the last 7 years, since 2007, the first 2 months of the market, we had more money leave mutual funds in the first 2 months of the market than we did mid-2008. Think about that for a second. In the first 2 months of this year, there's been an estimated $44 billion leave mutual funds. Okay, now I hope I'm responsible for a little bit of that, but just a little bit. But in $44 billion have left the mutual fund industry in the last 2 months. Why? The market is overvalued, and people are starting to get a little nervous, which means they're going to go to cash instead of invest in the funds. Does that make sense, everybody? And it's just because the market's overvalued. That's it. It's just overvalued, and for us to get out there and buy again, we need the market to come back down in price action, so at that point, then we can go buy it. Earnings reports, another part of fundamental valuation of the market itself. Earnings reports happen once a quarter. Okay, and basically the quarters that it's called an earnings season. You have January, which is basically the earnings season for the fourth quarter of the previous year. You have April, which we're coming up on into April. April will be the earnings reports for the first quarter of 2015. You then have July, that is the season for reporting second quarter, and then you have October, which basically is for the third quarter. And so you have 4 different earnings seasons every year. A company will report its earnings pretty much during that time period. Now, when a company announces earnings, they're going to announce both their terms of revenues, their earnings per share, and their guidance. Earnings per share, revenue, and guidance. Now, has anybody here ever seen a stock go down dramatically when the earnings was actually pretty decent? Oh, I have. Okay. Earnings, whether it's good or bad, guys, okay, it's a complete crapshoot. That's all it is. Earnings are a complete crapshoot. Now, do we ever short-term trade, swing trades, holding through earnings? No, never. Okay, we never take that risk. Do we hold longer-term investments into earnings? Yes, we do. Okay, so in terms of earnings, we might, if we own a company, we're not going to close it before earnings, guys. That's not what we're going to do, because we own that company for growth. We own that company for dividends. We own that company for cash flow purposes. We do not want to get in and out of the market every day. So somebody give me a stock that you wouldn't mind owning. Just give me a stock. CME. Okay. Now, CME here, by the way, I really like this trend right here. You see kind of this movement up, sets a higher high at $100, comes right back down in price, got a little bit of slowing momentum on the candlestick pattern there at a support level. That's a buying opportunity, I would say. In terms of looking at this stock, okay, could we, from a valuation perspective, this is a technically sound stock. We're going to buy it, right? We're going to buy it from a longer term perspective. We're going to buy it because we like the growth of the CME group. Well, looking at this symbol right here, this is earnings, okay? Now, on earnings, is it a very uncertain event on earnings? Yes, extremely uncertain, okay? So, I might, if I'm going to buy it, I might have to buy insurance to cover the downside risk, correct? And how do I do that? How do I buy insurance in the market to cover the downside risk? Yeah, I buy a put option. Now, I only want to buy a put option, though, if the analysis tells me I need it, okay? And what I mean by that is not every stock moves dramatically on earnings. For example, Microsoft doesn't typically move a ton on earnings because it's very, very liquid. Well, here is your last earnings report. The last time it announced earnings, it went from 91 up to about 91.9. So it moved $1. Okay, so it moved $1. The time before that was back here, and it moved from 81.60 up to 82.60. It moved $1. Okay, now the time before that, it basically moved from 75.50 to 74.50. It moved $1. All right, are you guys starting to see a theme there? Okay, now should I put a 10% hedge against a potential $1 movement in CME? Should I buy the insurance? I'm not going to buy the insurance, okay, because if it moves 1%, I don't care. Does that make sense, everybody? It's not going to blow up my stop loss, all right? So, but now let's look at another company here. Let's go with, let's go GMCR. Actually, let's go CMG. We were talking about CMG. Now, CMG here, okay, it announced earnings here. It went from 727 all the way down to 680. It moved 47 points on that earnings. This earnings, it went from 655 down to 625, moved 30 points. This earnings here, it went from 590 up to 630, 60 points. So if I invest in CMG and it moves $47, $30, and $60 on earnings, I probably need the insurance. Would you agree? Okay, so I'm not going to, if I'm a longer term investor because of this fundamentally strong stock, I'm going to do some analysis in it. I'm not going to buy insurance simply to buy insurance when the analysis does not justify the insurance. And it's my same belief that, for example, if in the marketplace, am I going to buy insurance in 2013 on my retirement account if the Fed is putting $85 billion of new money into the market? Am I going to buy insurance then when the market's going up 30% in 2013? I'm not going to do that. Market's going up. Why would I buy insurance? But in 2015, the market isn't going up right now, and we're dealing with a lot of macroeconomic risk. We're dealing with a lot of cycle risk. I probably need insurance on the retirement account if I don't go to cash. Would you agree? It's the same analysis that I'm making in the stock market, everybody. Okay, I'm allowing the information to help me make determinations on when I need the insurance and when I don't need the insurance. In CMG, you need insurance if you're going to own that company through earnings. On CME Group, you don't need the insurance going into earnings on CME Group because the information leads us to a conclusion that it only moves $1 a day. So that's as an investor. Well, what about as a Vega trader? okay, what's going to happen to volatility? And we'll show this very quickly. What's going to happen to volatility prior to earnings? It's going to go up, right? It's going to go up, okay, because people are buying insurance, right? People are buying insurance, which will drive the volatility up. Well, here, as you can see, prior to the earnings, the volatility goes up. Prior to earnings, volatility up. Prior to earnings, volatility up. After earnings, volatility crush, volatility crush. And so if I know when earnings are, I can make trading strategies, and I can put together trading strategies that profit off the simple volatility. Okay, now what would that be, guys? Some of you already know this. What would that be? What type of trading strategy would that be? Yeah, but what's the name of it? It's Vega, Jeremy. Yeah, buy a straddle. Okay, buy the call option, buy the put option. Buy them both. Buy the call option, buy the put option. Do you guys want to see how it works? Okay, so if I go to the trade tab here, I'm going to go to the analyze tab. Okay, and we're going to say, all right, we got no trades on Decker. There we go. Now, here I'm going to go to the option chain, going all the way out to June. And I'm going to buy that straddle right there, 72.5. I'm going to right click, analyze, straddle. Now what that means is I'm going to buy both the 72.5 call option and the 72.5 put option. Now if the stock goes up, what's going to happen to the value of the call option? It's going to go up, right? What's going to happen to the value of the put option? It's going to go down. They're going to offset one another. Okay, so if it goes down, the put option goes up, the call option goes down. So they're going to offset one another. Also, over the next 30 days, because this company reports earnings right there, May 27th, so about in 7 weeks from now, about 7 weeks from now. So what's going to happen over the next 7 weeks to the value of the option based on time? It's going to go down. Time's going to impact the trade, and it's going to go down. For example, if I hold this from today, and we'll just hold it for, say, until, May, it's about May 13th, okay? What happened to that white line, guys? I'm going to lose $300. That's what I'm going to lose, okay, based on theta. I'm going to lose $300. Now, where's volatility going to go? It's going to go from 28 up into about that range at 55. That's where I'm projecting, okay? So 28 to 55, how much is that? What's the price difference between 28, down here, you see it right there. What's the price difference between 28 to 55? It's 27. So I'm going to move up 27 basis points here. So let's adjust volatility up 27. Okay, what happened to the white line? Went up. Okay, so if everything works out the way we should, we have a risk-free trade, guys. If it literally does nothing, we're going to make $200. How many of you could use $200? We could all use $200, right? But that's on one contract, okay? That's on one contract. But it's only a $1,000 investment. What's $200? What's the return on your investment? It's a 20% return, okay? Now, if we get any price movement up into, say, $80, we make a 37% return. If it goes up to $90, we double our money. If it goes down to $60, we make a 40% return. Okay? And so if we get any price movement, now let's see if we have more contracts. Say we have 10 contracts. Well, instead of making $200, we make $2,000. All right? So do you see why we like trading volatility-based strategies? They're fantastic. We love them. Okay? We're just basically taking out all the directional risk. We take out the time risk, and all we need is this little blue line to go back up into where it always does. Okay? And is that a trade that you guys can practice right now? You don't want to live trade that one yet, guys. Wait till you get into the options courses, really kind of learn. But see, here's how I see this right now. We only have earnings once every 3 months, right? So do you really want to allow this earnings coming up go by without practicing some Vegas strategies? No, because then you're going to have to wait another 3 months. So get out there and practice this one. So by the time we get another earnings season, guess what? You've already practiced this one. Do we hold investments through earnings? Yes, but we have to do what? We have to analyze to see if we need the insurance. Okay. Now, can we trade Vega into earnings? Yes. Okay, but you don't hold that trade throughout. So again, what I would suggest, practice makes perfect out there. All right, so that's how traders will look at the earnings report. Again, it's a very uncertain time in a company's future, and a lot of time. I mean, we see a lot of gapping techniques. Now, we will talk about some techniques to where you will be able to analyze after the gap if it's a potential trade, short-term trade after that, because things in motion have a tendency to stay in motion. Now, from a longer-term investor, we're also looking to capture dividends. Now, a company will basically, they will, I want to say bribe because that's the right word. They will bribe shareholders to stay in their stock through two ways. Number one, a dividend. Number two, a stock buyback program. Dividend is a distribution of the company's earnings to their shareholders. Now, dividends are typically in the 1-3% range. Okay, AT&T is like a 5.5% dividend. AT&T literally goes sideways for decades at a time, and it has a lot of people invested in AT&T because they simply can capture a dividend. All right, they can capture 5.5% dividend every year on AT&T. And sometimes that's better than bonds, and it's better than other things out there as well. So dividends are simply a distribution of earnings to their shareholders. That's a bribe. Now, if a dividend gets too high, that's what we call begging. Okay? They need money. And so if you're getting paid a 10% dividend, you got to ask yourself if that actually is a good thing or a potential bad thing, because you will always lose more money on direction than you will on anything else. On anything else, whether it's a covered call, dividend paying stock, whether it's a carry trade in the currency market, you will always lose more money on the directional nature of the stock than you will on the actual cash flow. Stock buyback programs are a way for the company who basically buys back their own stock, taking shares out of the market. Now, when the company buys its own stock, taking out shares out of the market, what does that mean for the price? The price of the stock typically will go higher. Now, stock buyback programs are a good thing for investors. However, much like dividends, if you see too many stock buyback programs, that's not a good thing. And ladies and gentlemen, guess what we saw last year? A record number of stock buyback programs. Guess what we saw in the first quarter of this year? A record number of stock buyback programs. One of the reasons the market is still fading up is because of these stock buyback programs. What happens when the companies stop buying their own stock? Price drops. It has to drop. Okay, and so you want to you want to make sure you're aware of those types of things, guys. Dividends, stock buyback programs, they're a great way to take advantage of stocks, but you just got to be a little leery if it gets too much. Dividends, if it gets too high, you got to be a little leery at that. If you're seeing too many stock buyback programs, you got to be a little leery at that as well. Now, from the fundamental analysis, from an economic perspective, we study economic reports. Okay, we study economic reports because that is the actual valuation of the entire U.S. economy. Now, we get an economic report for literally every single thing in every marketplace. We get manufacturing reports, trade balance, unemployment reports. You get retail sales, housing, manufacturing, consumer confidence, inflationary reports. You get the big granddaddies of them all, the FOMC, ECB, Bank of Japan, Bank of England, those central bank reports. We get them on absolutely everything. Now, when we look at economic reports, ladies and gentlemen, let's look at basically how to read an economic calendar very quickly. So I'm going to go to forexfactory.com because that's my favorite one. I'll also show you the one over here at Tackle as well, but I do like the Forex Factory one a little bit better. The one at Forex Factory, you're going to click on the calendar right here, okay? And when you first do this, you're basically going to have a list that looks like this, Okay, when you first come to here, you're going to have a list that looks like this. Look how many economic reports come out every single week. This coming week, ladies and gentlemen, literally 100 different economic reports that are impacting the price action this week. And that is just an absolute ton of data. Okay, but let me ask you a question. Do you care about the final manufacturing report for the European Union? No, either do I. Do you care about the Japanese yen 10-year bond auction that's happening on Tuesday? Okay, I don't care about that, right? Unless you're trading the yen. All right, you only want to look at major economic reports, the ones that really have the ability to drive the market. So there's a button up here called the filter button. Hit that filter button, check on none, then go down to US dollar and only look at your red and orange ones. Now, even if that's a little overwhelming, you can filter out the orange ones as well. And so this week, here's the list of the ones that impact the U.S. Like I said, if you want to just look at the major ones, just click on the red ones there, and you can apply that. And these are the economic reports that really can drive the market. On Tuesday, we have the consumer confidence report. On Thursday, we get trade balance. On Wednesday, we get manufacturing. And on Friday, we get the unemployment rate. Now, if you do not know what this report is, for example, how many of you do not know what the ISM manufacturing PMI report is? Okay, and that's fine. That's fine. All right, so just click on this button here, and it will drop down and tell you what it is. So it's a level of diffusion index based on surveyed purchasing managers in the manufacturing industry. Here's the usual impact. If the actual number that is released is greater than the forecast, it's good for the US dollar. So the forecast is 52.5. So if the number comes in above 52.5, what's going to happen to the dollar? What's going to happen to the market? They'll go up. Okay, they should go up. Now, why you care about it, it's right down here. It's a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's views on the economy. For example, if a corporation who is in the manufacturing industry, if they're not buying very much, what does that tell them about the market itself? Brian, I think that's a misprint. I think it'll come on Thursday. Yeah, it means they're a little worried, right? They're a little worried. That's what that if they're not buying goods out there, it's mean they're pulling back a little bit. They're a little worried. Well, if the number is above the number, then they're actually getting out there and they're purchasing out there. And here's anything above 50 indicates industry expansion. Below 50 indicates contraction. Okay. I'm looking forward to this report on Wednesday for one reason. The U.S. economy will most likely go into some degree of recession over the next year. It's based on both the valuation of the U.S. dollar and the economic scenarios being played out in the world, with a lot of the top 10 economies in the world already going into recession or already starting to contract leading into a recession. That's going to come here as well. Well, this is an indicator for me that is it coming here sooner. And so if it starts coming in underneath this level, that's going to be very worrisome for me. Now, well, not for me, but for the national economy. Now, I want to show you a couple things over the course of the last few weeks. Okay, here we're going to look at the last 3 weeks from an economic perspective, and I'm going to show you why this is so important, ladies and gentlemen. Core retail sales. The forecast was 0.6. It came in at a negative. Retail sales forecast was 0.3. It came in at a negative 0.6. PPI report came in at a negative 0.5. The consumer sentiment report had its worst miss in years. It was expected at 95.6. It came in at 91.2. The next week, building permits were about equal, but the manufacturing index for the Philly Fed, that was expected at 7.2. It came in at 5.0. When you're looking at last week in the market, you had durable goods orders that was expected to come in at 0.3. It had its worst miss since 2008, ladies and gentlemen. And then the GDP number, the final GDP number, was supposed to be at 2.4. It came in at 2.2. Seemingly in the last month, ladies and gentlemen, we've had miss after miss after miss after miss, some of them grave misses when you're talking about durable goods, consumer confidence, and the Philadelphia Fed Manufacturing Index. we're starting to see the numbers really play out from an economic perspective. And so if we're coming into next week in the market and we have, consumer confidence miss, and we have trade balance get worse, and we have manufacturing miss 52.5, and we have the unemployment rate not reduced, that's going to be just a continuation of the misses out there, and those lead to contraction in the economy, ladies and gentlemen, which contraction leads into recession. Does that make sense? And so I don't go into the level of detail in my 3-day presentation like I do right there, but the numbers speak truth. They speak volume. And what it tells me is that the marketplace is at a significant risk factor right now. Significant risk factor. And when we look at the market right here, when we're looking at the ES contract here, okay, coming in, and this is just the marketplace, look at the last month in the marketplace. What does that look like, ladies and gentlemen? What does that look like? That's the last month and a half in the market. That looks like an M formation, and if it breaks that level of support right there at 2040, more than likely it's coming down into the 1980, 1990 level. And if it breaks those levels, you're probably talking about the market coming into 1840, and that could be your first 10% reduction in the market that we've had since 2011. All right. So I'm looking at this market and I'm saying, I'm a little cautious right now in the market, and that's why I'm not bullish. That's why right now I am neutral. And when you look at my portfolio, it's probably a third bullish, a third bearish, and a third neutral based strategies out there. And it's just based on what I'm seeing in price. It's based on what I'm seeing in from a fundamental perspective on the economy as a whole. And so when you start going, and that's why in your daily routine, you go to Forex Factory or in the Trade Center tab on Tackle Trading, you go to the economic calendar and you start to identify these economic events. And the first month you do it, guys, it's not going to make a lot of sense. But over time, if you see how the market responds this week to the manufacturing report and the consumer confidence report and the unemployment report, as you see that happen this week, then guess what? Next month when we get these economic reports, you now have an identification of what the report means, how important it is to the market, and then the third month you do it, it's going to become even easier, and the fourth month even easier, and the fifth month even easier, and it just gets easier and easier and easier. Ladies and gentlemen, I love economic analysis, okay? But it's not because I studied economics in school. I was a poli-sci brat, and I was a history junkie, and I went to law school. Okay, I understand economics and economic theory because for the last 10 years I've been coming to an economic calendar. The first one I utilized was at Yahoo Finance, and then I've used Forex Factory for a few years now, and I've understood how the market responds to these events. I understand how when you get all of these misses, it leads to contraction, it leads to recession, and we're starting to see the numbers kind of play out there in the marketplace. Does that make sense, everybody? And then when you compare that, and you cannot talk about market-related fundamental analysis unless you talk about market cycles as well. Understanding where we're at in the market cycle. We're at the very top of the market. We're at the top of the market from a GDP perspective. We're at the top of the market from a technical perspective. We're starting to see those misses, and we're starting to see massive problems out there in the marketplace. And it's time to take advantage of that to a large extent. And again, that doesn't mean it happens overnight, guys. That's not what it means. The market's going to be going up, it's going to be going down. We have to take advantage of both of those analysis. And then the last form of economic analysis or fundamental analysis is the actual Fed, the central bank. When you cannot leave out central bank monetary policy when you're talking fundamentals. And so in looking at the fundamental discussion we've had in this hour, we've talked about personal fundamentals, we've talked about corporate fundamentals, we've talked about market fundamentals, we've talked about economic fundamentals, and now we talk about the central bank and their monetary policy. Now, monetary policy is typically conducted through two different ways. Either number one, the Fed will raise interest rates, which they are more than likely to do that this year. I don't want to say it's a certainty, because there are some people out there that believe the Fed will wait till 2016 to raise rates. I am not one of those. I believe the Fed will raise rates in the third quarter of this year, more than likely in somewhere in the October range. I did push that out. I was one of the people for 2 years now that has been projecting the Fed raising rates in second to third quarter of 2015. I'm more on terms. If I had to put percentages to it, I would say there's a 20% likelihood that the Fed will raise them in either June or August, and then there's probably an 80% probability they'll raise them in October. I don't see them raising in December, so the highest probability for me would be the October Fed meeting, and if they raise interest rates in this environment, guys, that's what we're going to see as a catalyst, and that catalyst could be as strong as when Lehman Brothers went kaput there before the subprime market really kind of hit in the fall of 2008. But even before Lehman Brothers went kaput in 2008, was the market already going down? Yeah, it was. And so the market was already going down based on the market cycle. Lehman Brothers going out of business was one of those catalysts that just really drove the volatility to the downside. So when we're looking at this marketplace, the market certainly could be going in a downtrend coming into an interest rate hike. And an interest rate hike coming into that when the market's already going down, that could be a catalyst that was very similar to that Lehman Brothers event in August, September of 2008. Now, the Fed will raise interest rates at the top of the market as a way to control inflation. There's too much money in the system. The Fed will lower interest rates to put money back out into the market to stop bear marketplaces. They will also sell and buy government bonds through a process known as quantitative easing. Now, the central bank is now out of the quantitative easing business. They came out of the quantitative easing business in 2014. It was October of 2014. That doesn't mean the Fed's not investing, though, because when you buy a government bond, why do you buy government bonds? Why do you buy government bonds? To get paid something. Because you're nuts? I like that one, Brian. That was a good one. Okay, because you get paid an interest, or seemingly thereof, right? Okay, so what the Fed does is through quantitative easing, and it's supposed to be safe, Catherine, if you don't like making any money. So the central bank will print money to buy the bonds of which they sell to themselves, all in the name of lowering the interest rate that is loaned out there through the fractional banking system. Okay, now, the Fed will print the money to buy the bonds, and guess what government will pay the Fed? They pay them an interest rate. Now think about that for a second. The Fed prints the money to buy the bonds, of which they get paid an interest rate from the Treasury, whom they control. Okay, now think about that Ponzi scheme just for a second. So even though the Fed is out of the QE business, are they still making an interest on the 4.7 trillion US dollars they own in bonds? Yeah. So despite them being out of the QE business, they're still reinvesting the interest. Does that make sense, everybody? Okay, it's not something I like. It actually makes me want to throw up to a certain extent. But that's what the Fed does. Okay, so the Fed came out of QE. They're now just reinvesting the interest back into the marketplace, and it's kind of keeping the marketplace up while the rest of the market gets out and reallocates the price action. Now, there is a 96% correlation between the Fed's monetary policy, known as quantitative easing, and market direction, meaning 96% of the time the Fed gets out of QE, the market goes down. 96% of the time they print money, it goes up. So what we're faced with right now is we're faced with this. The Fed is coming out of the QE business. They're looking at raising interest rates at the top of a marketplace. It doesn't take a crystal ball to see where this leads. Okay? it leads the market to go down. And that's why economic and fundamental analysis is so important, because it allows us to prepare for these events. Nobody knows exactly when it's going to happen. That's why we make the trading decisions based on the price chart. But we do know for a fact that the market will crash eventually. Whether it's this year or next year, we prepare for that. We always trade the price action, but having an understanding of fundamental analysis from an economics and a central banking policy perspective allows us preparation and time.
You've been listening to the Trading Justice podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.